Hello and welcome to a session in which our topic of discussion is managing loans. You may remember from an earlier session, we defined capital as the money required to start, run and grow a business. Capital is of two types, fixed capital and working capital. Fixed capital helps an entrepreneur take care of one-time things in a business, and working capital helps in running the business on a daily basis. A question that every entrepreneur has to deal with before starting a business is, where will I get the required fixed and working capital? Entrepreneurs have two choices to raise the required capital. The first choice is to invest their own money. This is called equity. The second choice is to borrow money from others. These are loans. The business needs to repay the loan amount and also has to pay interest over that amount. In this module, we are going to closely look at taking and managing loans. Let's first become familiar with the terminology of loans. There are three important numbers about loans which every entrepreneur must be aware of. The first is the loan amount that the business is borrowing. It is called principal. The second is the term of duration of the loan. This tells us for how long is the loan taken by the business. The third important number is the interest rate. This is expressed in percent per year. When we multiply principal with the term and with the interest rate, we get how much interest amount the business has to pay every year. Let's take a simple example. A business takes rupees 1 lakh in a loan for 3 years and the interest rate is 10%. This means each year the business has to pay the interest equal to rupees 1 lakh multiplied by 10%, which is rupees 10,000. Thus, the business has to pay a total interest of rupees 30,000 for 3 years. And at the end of the third year, it has to repay the principal, which is rupees 1 lakh. We took this example to learn the simple mathematics to calculate interest payments. The example assumed that the interest rate has to be paid once in a year for 3 years. It also assumed that the principal has to be repaid at the end of the third year. However, in practice, this is not likely to be true. The lender, such as a bank, expects the business to make payments every month. This monthly amount to be paid includes some of the loan amount to be repaid and some interest amount to be paid. It is called equated monthly installments, or EMI in short. The advantage of EMI is that the amount to be paid remains constant for every month and hence the burden is distributed equally throughout the loan term. The standard mathematical formula behind the calculation of EMI is difficult to understand. So, instead, we will use an approximate method. It gives the EMI amount fairly close to the correct value calculated using the standard formula. More importantly, the approximate method is easy to understand. Here's how we use this method. If the loan amount is P and it is taken for n months, then we first divide P by n to get the monthly repayment amount. If the annual interest rate is R, then we multiply P with R and then divide this amount by 12 to get monthly interest amount. The EMI is the sum of monthly repayment amount and monthly interest amount. Let's use this method on the loan example we had taken earlier. P is rupees 1 lakh, N is 36 months and R is 10%. We divide rupees 1 lakh by 36 months to get rupees 2,778. This is monthly repayment amount. We then multiply 1 lakh by 10% and then divide by 12 to get rupees 833. This is the monthly interest amount. If we add the 2 months, we get rupees 3,611. This is the approximate EMI. In case you are curious, if we use the standard mathematical formula for EMI, we will get rupees 3,226. The approximate method overestimates the EMI a little bit compared to the standard method. There is a very important point about EMI which every entrepreneur must keep in mind. The longer is the term of the loan, more is the overall interest paid, but lower is the EMI. Let's take an example to understand this point. Let's look at 3 loans. Each is for rupees 1 lakh. So P is rupees 1 lakh for all 3 loans. But the term of each loan is different, and hence the interest rate charged are also different. The first loan is for 1 year. So N is 12 months. This loan has an annual interest rate or R of 6%. The second is a 2-year loan. That means N is 24 months. Its R is 7%. The third is a 3-year loan, which means N is 36 months. This has an R of 8%. Let's calculate the EMI using approximate method for each loan. The first loan has a monthly repayment amount equal to P divided by N, which is rupees 1 lakh divided by 12. This comes to rupees 8,333. The monthly interest amount is equal to P multiplied by R divided by 12. That means rupees 1 lakh multiplied by 6% and then divided by 12. Hence, the monthly interest amount comes to rupees 500. If we add these two numbers, then we get an approximate EMI of rupees 8,833. We can do similar calculations for the other 2 loans. For the second loan, the monthly repayment amount comes to rupees 4,167 and the monthly interest amount comes to rupees 583. This gives an EMI of rupees 4,750. For the third loan, the monthly repayment amount is rupees 2,778 and the monthly interest amount comes to rupees 667. This gives an EMI of rupees 3,444. As we can see, the third loan has the highest interest paid, but it has the lowest EMI. Once again, if you are curious, the standard EMI formula will give EMIs for the 3 loans at rupees 8,606, rupees 4,477 and rupees 3,133 respectively. As we discussed earlier, the approximate method has slightly overestimated the EMI, but the conclusion is the same. And that conclusion is worth repeating here. The longer is the term of the loan, more is the overall interest paid, but lower is the EMI. When entrepreneur takes a loan, there is often an impulse to repay the loan as early as possible, so as to avoid paying high interest and to get rid of burden soon. But as our example showed, paying off loans early also create a lot of burden every month on the business. So, it is better to take a longer term loan even if it comes with a higher interest rate because it reduces the EMI significantly. Before we close the session, let's briefly talk about the sources of loans. The most common source of loans is banks. They often have schemes to provide loans to small enterprises. Banks require a business plan for the entrepreneur to approve the loan. In another session, we will see how business plans is made. Banks sometimes require some security or collateral to safeguard the loan. The entrepreneur's land or property can be used for this purpose. Such secured loans usually come at a lower interest rates than the unsecured ones. Banks do not usually give loans easily for working capital, but it is relatively easier to get a loan for fixed capital. Hence, entrepreneurs may have to approach others such as family members and friends for working capital loans. Let's now summarize the main points which we discussed in this session. We define capital as the money required to start, run, and grow a business. Entrepreneurs have two choices to raise capital. The first choice is to invest their own money, called equity. The second is to take loans. There are three important numbers about loans which every entrepreneur must be aware of. The first is the loan amount called principal. The second is the term or duration of the loan. The third important number is the interest rate. Loan interest payments and repayment of the principal are usually made every month. Such a payment is called equated monthly installments, or EMI in short. The advantage of EMI is that it distributes the burden equally every month, which makes it manageable for the entrepreneur. The longer is the term of the loan, more is the overall interest paid, but lower is the EMI. So, it is better to take a longer term loan even if it comes with a higher interest rate, because it reduces the EMI significantly. That, in a nutshell, is about managing loans.